Okay, as I said, this is the other end of the spectrum. Okay, we looked at the left-hand side of the spectrum, we'll call it the purely competitive market. Now we're looking at the right-hand side of the spectrum, which is the pure monopoly. And as I say, two of those are theoretical. They're not really, there's no such thing as a pure monopoly nor pure competition. So this is one of the what we call market structures. And effectively, when we talk about market structures, what we're dealing with is how do the buyers and the sellers interact? So what is that interaction between the two? So this particular one, again, is going to answer these two basic questions. What output will firm choose to produce and what price will prevail? Now, I will tell you in this particular section, I'm not going to focus on the numbers, okay? We looked at the numbers more for the purely competitive market, and we'll look at them a little bit here. But in terms of the problems and these sorts of things, no. Going to focus on the implications more than the numbers. So what we're going to do, we're going to explain what monopolies are and how they come into existence. And effectively, why they must reduce their prices in order to sell more. We're going to talk about that aspect of the numbers. We're going to describe how the profit maximizing output and price are determined for a monopolist. Again, very similar to what we did with the other section dealing with the pure competitive market. The key things is we're going to look at the grounds on which a monopoly can be criticized. Okay, what are some of the challenges with the monopoly? And the differences that exist, particularly how a competitive market handles the situation and how a monopoly handles the situation. Then we're going to look at, well, what are some of the positive things about a monopoly? What are some of the grounds on which they can be defended? And finally, we're going to look at how can government get involved in order. If you need a monopoly, or if that defense of a monopoly is true in the sense that the environment we work in a monopoly has to operate, what can government do in order to manage the behavior of these monopolists? So effectively, when we think of a monopoly, by definition, a firm is considered a monopolist or a monopoly if it is the one and only, the sole producer of a product for which there are no close substitutes. The firm not only dominates the industry, the firm is the industry. And there's no competition for the monopolist, which leaves very much power in the hands of monopolists. Okay, so when we think about monopolies, they are a sole producer. So that means that they're the only ones that you can buy the product from. If we think of a coronavirus vaccine, for example, we're seeing more and more of them coming up now as potential offerings. But generally, the Pfizer one was the first to market. So if the Pfizer one is the first to market, it really is going to be the sole producer. It'll have a monopoly position for a little while at least. It's the sole producer of the product. And it's not as if there are lots of substitutes if we consider that to be the only one that's available. So you can't go and find something else. Now, we could ask ourselves, well, what do we got around here that look like monopolies? There's not a lot. But again, everything is kind of relative too, because the wider the market, the sense of accessibility, in the sense of accessibility for customers, the less likely a single firm is going to dominate the market. So here in Clareville, or places like St. John's or Toronto or the larger centers, you're going to see a tremendous amount of competition because there's lots and lots of producers of the product. So for example, we go to buy gasoline. There's lots and lots of gas stations for gasoline. Now, you could argue the price is all the same. It is. And we talked about that before. But we could argue that it's certainly not a monopoly because we have choice. We have that choice. However, if we were to think about the production of gasoline, when the refinery was open, it was the sole producer of the product in the province. It's not as if there's a multiplicity of producers producing gasoline. So it more or less had a monopoly on gas production in the province. Now that the refinery shut down, they're having to ship in all the gasoline. So we're seeing product being brought into the province from somewhere else. It's not as if either that there's a lot of close substitutes for gasoline. It's not as if you can put something else in your car if you don't have gas. You have to buy the gas. So from a production perspective, we could argue that, yeah, production in Newfoundland and Labrador was very much a monopoly for North Atlantic refining. Now, if we go to larger centers, more and more producers are available, more refineries, more things. So it's less likely to see a monopoly in a larger center. Monopolies could exist, though, in a little town. So if we go out to Buckens, for example, there's only one gas station in Buckens. It's not as if you got much choice. You go to the single gas station or you don't buy any gas. You got to drive to Badger, which is 73 kilometers away, to get some gas. So there's not a practice. So monopoly is kind of a gray term because it's a monopoly in the eyes of the consumer, I would imagine. Is the consumer really willing to go that distance in order to find a competitor? If they're not, then we could argue that that is a monopoly that we're dealing with. So it deals with the accessibility. Now, the other question that we ask is, how do these monopolies come into existence? What causes monopolies to occur? And there are a whole bunch of reasons. There's a whole bunch, but they can all be boiled down into three basic reasons. Okay? And these three basic reasons are collectively called barriers to entry. It is what keeps people out of the market, or competing firms out of the market. So monopolies form because of difficulties experienced by other firms who attempt to enter the same market. The market may not be big enough. It may cost too much money to get into the market. There may be laws that prevent companies from getting into the market. There's a whole bunch of reasons, okay? So monopolies are really protected from the competitors by these barriers to entry. It keeps them from always, the environment from always changing. And we can classify these basic barriers as three types: technical barriers, legal barriers, or economic barriers. From a technical point of view, technical barriers are those that make it difficult for other firms to duplicate what the monopolist is producing. So they tend to be the sole owner of the resource or the technique. For example, in North Atlantic, a refinery would cost $5 to $6 billion to build. It's really complicated to put together a refinery. It's not as if anyone can put one together. So it's really very much a technical barrier. So sole ownership of the resource conveys a monopoly. If you got a diamond in your possession, most girls tend to have some diamonds somewhere along the line. If you got diamonds in your possession, diamonds are an interesting commodity because normally they are produced by a monopoly. There's a South African family, or South African family-owned company called De Beers. And De Beers owns most of the diamond mines in the world. So as a result, they've gathered all of the resources where diamonds are produced. So they more or less have a monopoly on diamonds. In fact, De Beers have had that diamond monopoly for quite a while. And that's part of the reason that diamonds are so expensive, is that it is more or less, it's not a pure monopoly, but it is more or less that kind of a monopolistic type operation. And De Beers keep the money up. Back when I was your age and I was in school, I was introduced to the IBM personal computer. That was 1984 in the engineering building at the university. And IBM produced the first personal computer. Okay, they were the ones that produced the first one. And more to the point, the operating system on the computer was made by Microsoft. There was a partnership between IBM and Microsoft. Microsoft produced the software that ran, regardless if it was an IBM computer or a Dell computer or something else. IBM had an agreement with Microsoft, and Microsoft had an agreement with a lot of the other computer manufacturers to ensure that they produced the operating system for the computer. And MS-DOS, as we knew it back then, Microsoft Disk Operating System, was the type of system that made that computer work and every other computer work. and everywhere you went, it was an MS-DOS system. And man, was it ever complicated. But the fact of the matter is that that was more or less a monopoly. And Microsoft and Paul Allen and Bill Gates, who own Microsoft, made billions and gazillions of dollars to do that. Paul Allen since died. Bill Gates is the richest man in the world right now. So that was an example of a technical barrier. We also have what's called legal barriers. Legal barriers to entry are laws are put in place in order to ensure that a certain company has a monopoly for any number of reasons, okay? But a legal barrier prevents other firms from competing in a particular industry by the force of law. So you're saying to me, well, you know, gee whiz, government is really creating that because government are the ones who create the laws. That's true. And so a government facilitates that. I didn't put it in the slides, but just to talk about patents, for example. A patent is a guarantee that a company can get to keep its product a monopoly for 20 years. We talked about patents in law last year, but effectively, the government will grant you, if you come up with an invention for some product, you can go to government and request a patent on that, which is a product, a design, a shape, something that has some value. You can go to the government and pay the patent office to register your patent. And effectively, what they'll do in return is they will publicize the fact that you own and make this item and that you have the sole rights to it for 20 years. So you will gather all the benefits. Even if another company makes the same thing, you can get royalty payments from them for that product. You can actually lease them the patent. So you can become quite well off. And the idea behind a patent, the business idea is that it helps spur innovation because companies come up with ideas, they can get a patent and make a lot of money very quickly. So it encourages companies to do this sort of thing. The downside for us is that we'll end up paying high prices for a lot of products. A lot of drugs, for example, are patented. So until they're 20 years old, they tend to be really expensive because they're only sold by one company. Other instances, for example, of which government will say, yeah, it's a good idea to create some sort of a barrier on that, is when you got a situation where it's not practical for multiple companies to enter the market. Take, for example, power distribution. The Newfoundland Power Company and its fellow companies across Canada are private companies that buy the power from the producer, in our case here is Nalcor. They buy the power and they bring it to your home. So the power poles that you see out on your street and the wires that come into your house are owned by Newfoundland Power. That is a monopoly. They're the only ones that you can buy power off in this province. You can't buy power anywhere else. There is no competitor because government has given them the legal right, the exclusive right to sell power. Now, why did government do that? Well, practically, it doesn't make any sense for multiple power delivery. Poles going everywhere. It's bad enough now with all the poles. You'd have a lot of poles. You'd have different companies with different poles, with different wires. We wired up infinitum. You know, the technology does not allow us to have multiple systems in terms of power distribution. And back in the 70s, that was also the case with cable television. Cable television was a cable connection that you had to your house. So people like Danny Williams got very wealthy because they had a monopoly on cable distribution in, well, the greater metro area in St. John's. Now, technology has since changed to allow cable TV to come in multiple different ways, through the internet, through satellite, you know, any number of ways that you can get cable. So that kind of monopoly has since disappeared, but it was the case back in the 70s. And companies were given that monopoly by government legally in order to solve some of the problems, the technical problems that would result by too many power lines strung all over the place. So, you know, other types of legal restrictions designed to give private firm protection from competition, such as licenses, patents, copyrights, all these sorts of things are legal, and they all are given by government for good reason in order to encourage a company to develop and provide a service. Sometimes what government does in order to get around the problem of single owner companies being given a monopoly is they'll create what's called a crown corporation, which is a government owned company. And a crown corporation will provide those services. The government actually provides the services through a crown corporation. That was the case with the Canadian Broadcasting Corporation. CN was originally a crown corporation, it's not anymore. Marine Atlantic is a crown corporation. Newfoundland Labrador Housing is a crown corporation. These are companies that provide services that, if not so much now, but many years ago, would not have happened. Like, you're not going to get someone making money sailing across the Gulf in order to bring traffic to the island of Newfoundland. It's not. So government has stepped in and done that. So these are sorts of things that are what are called legal barriers. Thirdly, there's something called economic barriers, and oftentimes these barriers kind of overlap, but an economic barrier is really a money-related barrier. It just costs too much. So economic barriers are presented when there's extensive startup costs for new firms. So the bigger the initial investment, the more difficult it is for new entrants to join the industry. So there's lots of examples of very expensive companies, very expensive things. Airplanes, for example, are very difficult and expensive to build. Nuclear power plants are very expensive to build. Ships, same thing. Oftentimes, in order to facilitate this sort of thing and encourage this sort of thing, government will create legal, but also the legal will also be coupled with economic barriers. So, for example, the automobile industry, if we look at the automobile industry, there's only a handful of manufacturers of cars. So it's difficult to compete internationally with a major automobile firm unless you're ready to invest billions and billions and billions of dollars. So you need a big, heavy wallet in order to compete. Should be noted that the investment needs to encompass not only the fixed cost of building factories and an assembly line and all these sorts of things, but you also got to think about the cost of distribution, the distribution network, the marketing, all these sorts of things are very, very expensive. Designers, engineers, executives. It's really a hurdle in order to create a car company. So automobile firms tend to be large because of extensive economies of scale, which allow big firms to produce at much lower cost. So if you can't get big enough, you can't get the economies of scale. Now, this has been a challenge with Tesla. Tesla is a new automobile company that did not exist 10 years ago. And it's a different kind of car company because it produces cars that are all electric, okay? Now, you ask yourself, well, how could this company start if these economic barriers existed? Well, the fact of it is Elon Musk owns Tesla. Elon made billions of dollars with a company called PayPal. He created PayPal, and I'm sure you may have used it. But PayPal has allowed him to accumulate a huge fortune, which he has been able to parlay into building this car company. The car company doesn't really have any dealerships around here, and it's very hard to find them in Canada. And in fact, if you wanted to go buy a Tesla, this is how you go buy it, on their website. So you go to their website, you click through, you pick the model, and you basically order it with your credit card, and it gets delivered to you. Now, thankfully, with an electric car, there's very little maintenance on it, unless it gets damaged in an accident. The maintenance issue is not as big as it is with an internal combustion engine. So, they can do that. But it is a major challenge for Tesla, and a big problem. If you watch some of the forums out there, the internet forums on Tesla, that's the number one complaint, is getting the car serviced can be a challenge and expensive. And again, Tesla in and of itself, if you look at it, you say, well, it's not a monopolist in the car industry, but it is pretty well a monopolist in the electric car industry. So those are the three things. So that's important for you to be able to take that away and say, okay, we got these economic, legal, and technical barriers that facilitate the growth and the development of a monopoly. Okay, any questions on that? Well, that's our first part. Now we'll take a look at a little bit at the money issue. Okay, so like we have learned over the last little while, price times quantity generates a revenue. Revenue minus the expense creates a profit. So the standard accounting rules apply. So a monopolist, unlike a competitive producer, is a price maker rather than a price taker. In other words, the monopoly can set the price because they're the sole producer, there's no competitors, they set the price. Which means they're able to set the price at whatever level it chooses rather than to have to accept a market determined price. So if we were to say, for example, a company like Tesla is a monopoly in the electric car world, they can set their prices rather high. And they do. This car here that we're looking at is probably $80,000 plus tax, which is, a good bit more than an equivalent car. So that they can set their price. Now the challenge is that they still don't have total control, because if you look at the price and you say that price is too high for me, that Tesla could be too expensive for you, you're going to say to yourself, I'm not going to buy that. You still have a certain degree of choice, even though you're in a monopoly market. No one's forcing you to buy the product. So even so, still customers to decide how much they will buy at that price. Alternatively, a monopolist might determine the size of production that it wants to set and set its price accordingly. So, for example, in the case of Tesla, they only have limited capacity in terms of production. They don't have hundreds of factories like General Motors or Ford or others would to be able to ramp up production. They only have one or two factories, and they have another one in China. So they're limited in terms of their production ability. So they're keeping the price high because of that, because they don't want everyone rushing out and trying to buy that and be disappointed. Basic takeaway from that is that a monopolist can determine either the price for their product, or they can determine how many they want to sell. They just look at the demand at a given price and they'll say, okay, we're gonna produce this many, so we're gonna set our price according to that quantity level. So they can determine either the price or the quantity, but they can't determine both of it. It's one or the other. They have to select the price or they select the quantity they want to sell. If we look at this table, which is very similar to the one that we had in the purely competitive market, we can see quantity, price, and total revenue. Quantity times price will give us total revenue. 1 times 20 is 20, for example. 2 times 19 is 38. We can also see the average revenue, and average revenue works the same way as it did over in the purely competitive. You take the total revenue divided by the quantity, the number that's being made. So in the case of total revenue of 20, 1 was being made, 20 divided by 1 is 20. In the case of 2, 38 is total revenue, 2 is being made, 38 divided by 2 is 19. So you can see that the price and the average revenue are the same. And you will notice too that we can calculate our marginal revenue here, which is basically the same type of setup. Now, you ask yourself, what is the point at which revenue is maximized? Well, you'll see that the quantity of 10 and the quantity of 11 generate a maximum revenue of 110. And if you look at marginal revenue, if we use marginal revenue as a tool to determine when our profit or when our revenue is maximized, you're going to see that when marginal revenue equals 0, that we're at the maximum. So I've just noted here as with the competitive firm, the average revenue is the same thing as price. Note also that the total revenue increases with quantity sold, but only up to a point. Again, same sort of thing, that our revenue will only go so high and then it will start to decline. So for a monopolist, marginal revenue is not equal to the average revenue. That's different than what we got for a purely competitive firm. The extra marginal sales revenue that monopolists receive for selling one more product is not equal to the price. This is because when the monopolist sells one more unit, it gains revenue equal to the price at which it sells the unit, but it loses revenue because it's forced to drop the price in order to sell more. Remember, it can either pick the price or pick the sales. It can't pick both. Not only on the additional unit, but every unit it sells. So effectively, a monopoly, if they drop the price, they got to drop it for every single unit, not just one. And we can see too that the monopolist has a downward sloping demand curve, as every other firm. As this can be expressed another way, since a monopolist and the industry are one and the same, faces a market demand for its product, and demand is represented by a downward sloping demand curve. So effectively, the higher the price, the less product that you're going to sell. The lower the price, the more product you're going to sell. So from a customer's point of view, this means as price drops, you'll buy more. From a monopolist perspective, it means in order to sell more, a monopolist must lower its price. A monopolist cannot sell all at once at any given price, is forced to decrease the price in order to sell more. So they're facing the exact same type of environment that we would face in a competitive market. So as I say, the monopolist is, in order to sell more, got to drop its price. In order to increase its sales, is forced to reduce its price, not just on the last unit, but on every unit of output. So the total revenue is maximum when the marginal revenue is neither positive or negative. That is when it's zero. We just talked about that. We saw that in the thing. So a monopolist will only produce when the demand is elastic, meaning that its revenue is increasing. So the profit maximizing output for monopolists is when the marginal revenue equals the marginal cost, as we've just seen. And the price the monopolist will charge for this output is the maximum possible price given the market demand curve. So effectively, it will charge a price that gets that marginal cost and marginal revenue together. We also have this issue of price discrimination with a monopolist. A monopolist sometimes can try to increase its revenues by discriminating. In other words, it can either charge different prices to different people or different buyer groups. So two major forms of price discrimination: discrimination amongst units produced. And when we talk about the units produced, we can think about a 2-for-1 sale. So for example, what it's doing is it's charging a higher price for one item and a lower price for the second item. A 2-for-1 is effectively you pay the full price for the first item and a lower price. So effectively, monopolists can do something like that. That is, sell a 2-for-1 or 3-for-1 or create some sort of a price difference between its products to the customer. And this is a form of what we call price discrimination. The idea is to generate more revenue. You can also discriminate amongst buyer groups because different groups of consumers will demand different products at different prices. Some people are going to be interested in the Tesla Model X. Some are going to be interested in the Model Y, for example. The key thing that I want you to take away from this chapter is this issue of the good and the bad with the monopoly, okay? First, we look at the bad. What's so bad about a monopoly? Well, monopolies are often criticized for not being that efficient. They don't have to be efficient. If you think about it, they can set up their volume enough to make a profit. Okay, they can set up their volume enough to make a profit. And if they're happy with that profit, effectively, where there's no competitors, that profit will continue forever. It's like a golden egg that keeps being laid. So Newfoundland Power, for example, where there's no competitors, they can set their price and they know we're going to generate this much revenue at that price. So they know their expenses, so they can calculate their profit. And realistically, there's nothing to change that profit over time. Nothing's going to come into the market to steal away their market or to do anything to actually increase their costs. They'll get their economies of scale to be able to, so being able to make profits indefinitely is often considered to be a problem with monopolies. Because what is the incentive to do better if you know you're going to make a profit indefinitely? You can do anything, practically anything, and you'll still make a profit, right? So what's the incentive to innovate or to do things better or to find different ways or offer up new product offerings to satisfy a customer differently? There's nothing. So because the economic profit indefinite is there, monopolies tend to get stale and they're not the most innovative things in the world. And as a result, human society doesn't necessarily benefit in terms of innovation and these sorts of things. As I said, because they make profit indefinitely, they're not really interested in being efficient. They don't have to be efficient. They don't have to get their sales up to the level that they got the economies of scale. They don't have to use their money wisely. They don't have to borrow the least. They know they're going to make money anyway. So, it's like there's no incentive to produce efficiently, nor use their money resources efficiently. Okay, so productive efficiency and allocative efficiency doesn't need to exist. And again, that doesn't help society as a whole. We've seen a lot of this. As I say, Paul Allen and Bill Gates made a lot of money with MS-DOS and Windows that came after that. They got extremely, extremely, extremely wealthy. And what it does is the owners of the monopoly get very rich. Everyone else is going to pay the cost of it. Now, Bill Gates today, he's kind of making amends. He's got the Bill Gates Society, Bill and Melinda Gates, and they're giving money left, right, and center to third world countries. But the fact is that he gathered up this massive wealth, and a lot of people got poorer because of him collecting all of the revenue. So this unequal distribution of income and wealth within the society is exacerbated by monopoly. Those who have it, and those who don't. Now, you could argue that the same is also true with a purely competitive market. Well, in a purely competitive market, there's nothing stopping someone from getting into the market and doing something different. In a monopoly, there is something stopping. So monopoly, you could say that there's shades of gray, but the fact of the matter is that a monopoly is a much darker shade because of this inability for people to get in. And finally, a monopoly can price discriminate. So it can charge different markets, different rates, different people, different rates, and it allows it to do those sorts of things unencumbered. And this is what they mean. They can practice price discrimination. Harder to do that in a competitive environment. So if we compare the two, if we look at, monopoly versus perfect competition, monopolies are productively inefficient and allocatively inefficient. Purely competitive markets have to be productively efficient and have to be allocatively efficient. Otherwise, they won't survive. So monopoly can go on forever being inefficient, whereas a purely competitive firm is forced to be efficient. Otherwise, it will leave the market. Monopolies can charge higher prices indefinitely because they're the only game in town. Perfectly competitive firms are price takers. The market determines the price, and the price can fluctuate up and down depending on supply and demand, but they effectively will always offer a price that the market agrees is fair. Monopolies, not the case. Monopolies don't have to produce the output level. They don't have to be efficient, remember. They don't have to get the economies of scale. So monopolies can produce lower output and still make money than a perfectly competitive firm. So the monopoly will have an output that is lower than the economic capacity of the firm. In other words, it may not be run as efficiently as it can. So we saw a lot of that with firms over the years who have had former monopoly type firms. Newfoundland and Labrador Liquor Corporation, for example, is a monopoly. There's always an occasional news item on about how they're not necessarily efficient in terms of their operations. For example, liquor stores with lots of people working and very few people in the store, or liquor stores that have a lot of product on the shelf that is too high priced and it doesn't sell very well. You know, these are the types of things that come about whenever we get a monopoly, and we hear tell these often. Very seldom do you hear tell them in a competitive market. The other side of the coin is that, well, you know, are monopolies as bad as we say they are? And why do they exist if they're so bad? Well, you know, monopolies do have a place in the market. In some environments, they work well. For example, they capture these large economies of scale and therefore tend to be more efficient, or they tend to exist, whereas other firms weren't. Newfoundland, for example, is a case of a province that is so darn spread out. You got, you know, 1/3 of the population that live on the Avalon Peninsula, and 2/3 spread over a landmass that's bigger than the United Kingdom. So we got a huge landmass, a weird distribution of people, and yet every one of those people want electricity, telephone, internet, high speed, you name it. Well, you know, a monopoly, if Newfoundland Power is the company behind the power system, they have enough size because they are a monopoly to get a good deal on poles or to get a good deal on water or these sorts of things. So they capture some of the economies of scale that wouldn't exist if we had a bunch of small companies trying to cut up a very small pie. We could also argue that monopolies work on a lot of research and development into new technology and new products. This is often be an argument for NASA, for example. You know, if we think about the National Aeronautics and Space Administration down in the United States, NASA was formed back in the early 1960s in order to help put man on the moon. It was thought that that was the best way to move forward with it. And it was, because it was a central organization that hired a lot of smart people to do something that was very expensive, and it got done in 1969. Today, we're seeing that because of that research development, you know, a lot of new products have come about, not the least of which was the internet. So, you know, we've seen a lot of benefits from that. When I was growing up, the biggest benefit of the space program was Tang. And now you don't even know what Tang is, I imagine, but Tang used to be like fake orange juice that we all, in the 70s, everybody had Tang. And Tang was part of the product that was invented for the moonshots. It was a freeze-dried type of process that was used in order to have food on the moon. So this extensive research and development ended out into the marketplace, and a lot of us have benefited from that. The GPS systems that's up in space, for example, you know, a lot of these things are NASA figured out systems. Next time you're flying on an airplane, you see the winglets out on the edge of the wings. That's a NASA concept in order to get better gas mileage for airplanes. So a lot of research was developed because of NASA as a monopoly. Now, as time has gone on, we're seeing more private firms get into the space business. So, for example, SpaceX, and that's changed a lot of those rules. But in the early stages, a lot of research and development. The good thing, too, with monopolies, they tend to, because they have their pick of people to work for them, they tend to pay good wages and working conditions for the employees. They're big enough. They're financed well enough. They're guaranteed to make a profit. They can afford to pay decent wages. So they're not always scraping for a dollar, right? They have money. So the wages that are offered are considered to be, it's a better place to work. So now that we've figured out, you know, monopolies have good and bad, and we know that because some of the good, and they are necessary in some environments, okay, we got to ask ourselves, what do we do then if we have monopolies? What can we do to control them, to manage them? If we got to have them, how can we manage them? What are some of the things that we can do as a management tool? Well, governments aim in regulating monopolies usually to bring more positive results. And the idea, hopefully, would be to force that monopolist to cut their costs, make enough profit to survive. I'm just moving here. Make enough profit to survive, and do all right, because it doesn't need to make a whole heck of a lot of money, but it got to make enough in order to stay in the market. So governments often try to force monopolists to manage the prices. I don't know if to minimize the prices, but to reduce prices, profits, and increase output. So government often comes in and tries to get them to do things that they would not naturally do. So in order to do that, government has really three basic approaches it can use in order to twist the arm of monopolists. The first thing they can do is to tax the monopolist. Okay? If you want to get a company to do something in your government, one way to get them to do something is to charge them tax. So this could be a lump sum tax, or per unit tax, or per item tax, pollution tax, any form of tax. So the idea is that the tax is designed to change behavior. So, if you impose a tax on monopolists, it will force the company to change. So, in the first case, price and quantity will be affected by the tax. They'll have to increase their prices or do something or reduce their quantity. And in the second case, price increases and quantity decreases. So, but the fact of the matter is that the profits of the monopolists will be reduced because government will skim off some of the profits and be able to use it to counter monopolists. The other thing government can do is go in and say, okay, instead of taxing you, we're going to tell you what price to charge. We're going to set the price. And this is exactly what happens with Newfoundland Power. What happens with companies like that is the government sets up what's called a price control agency, a marketing board, or the consumer watchdog entity. And effectively, whenever the monopolist wants to increase the prices, it has to go to that board by law and say, we want a price increase, here's why. And that board has the ability to say no. Okay? So effectively, the government will create what's called a social optimum price, which is the price that's fair, what it considers to be a fair market rate of return. The final option for a monopolist is it can nationalize the monopolist. And that has happened in several cases. So effectively, what happens is government says, gee, this monopolist is not doing what we want. It's making too much money. It's ripping people off. We're going to go in and buy the monopolist. So nationalizing means that the government goes in and buys the monopolist out. So converting it to a crown corporation. We have seen a lot of calls for that. Like, for example, I've seen lots of calls in the last month for the government to go buy North Atlantic Refining as opposed to letting that company run it. The challenge is that that's $6 billion, and who's going to argue that? Who can argue that? Who is going to? Can the government run a refinery better than the company? Probably not. So those are the key things that you want to take away from that chapter. So again, if you had to do a quick summary of the chapter, we gotta know what a monopoly is. It's the only game in town. They came into existence because of barriers. They maximize their profits or they maximize their output. They can choose one or the other. There's 5 basic grounds in which monopolists are criticized. They're not very efficient. They can make profit indefinitely. They have total control. They don't necessarily, do the things that we want them to do. There's also reasons that monopolies can be defended. That they're innovative and they pay good money and they fill a need. And we've also talked about what government can do in order to manage the monopoly. So that effectively is that chapter, and that's what I want you to take away with this chapter is that's that is the takeaway that I want you to take from this chapter is the pluses, the minuses of monopoly, and what government can do to manage them.